Hello, I'm Rachel Rickard Straus, editor of Moneywise. I'm here with Ben Edwards, who's going to explain bonds to us. He is manager of BlackRock Corporate Bond Fund. Ben, thank you for doing this for us.
My pleasure.
What is a bond?
Well, a corporate bond, I guess, is debt that's issued by companies in exactly the same way as companies need money from the equity market. They start with an IPO, they might have to raise money via a rights issue. This is all cash that can help them build their business. What's happening on the other side is they're continually coming to debt markets, continually borrowing, and the sort of companies that we're talking about are too big just to go to their local bank and ask for a loan. So what they do is they come to large institutional investors, they borrow money. Some of these companies might have to borrow 3 or 4 times throughout the year. In the case of a bank, it might be 20 or 30 times throughout the year, consistently raising funds to help them manage their business. What that means effectively is you have a balance sheet for these companies and a balance between debt holders on one side who have the first call on cash that's generated from a business. Ultimately, we are the most important. Obviously, I would say that. Cash has to be repaid first to us. Whatever's left is then made available to equity holders. I would caveat that, but then by saying that shareholders are the ones that hire CEOs and management teams, and so their focus tends to be on building that dividend over time. What's important for us is to make sure that they're doing that in a sensible way, that they're not changing the stability of that company, and they always have, and for the future, some of these bonds are quite long dated, the ability to repay that debt when it comes due.
So there's 2 types of ways, as I understand it, that a company will raise money. There's through issuing shares that people can buy, that investors can buy, and debt. And the debt is the bond element, which they get first dibs effectively on any kind of income, after which the shareholders get it.
Absolutely.
And then the other difference, of course, is that bonds will pay fixed interest, whereas a shareholder, the value of shares will rise and fall.
Traditionally, that's the case, yes. I mean, you can have a variable rate bond. Most of them pay a fixed rate of interest, which is why they have interest rate sensitivity. And the other thing I would say is that bonds must be paid or companies default. Whereas a dividend can be stopped. If a company runs into trouble, they go through a period where they need to turn a dividend off, or in fact just to reduce it a little bit. That gives them time to rebuild their financial strength. Bonds have to be paid. If they ever don't pay them, then the company effectively defaults and receivers can be appointed. And at that point, obviously, usually management is removed, so they tend to try and avoid it.
So we talk a lot about a balanced portfolio, and this is one of the best ways of balancing, that you have some shares, some bonds, because, as you say, they balance each other out. The shares, they rise and fall, there's more volatility. The bonds, a little bit more security, because, as you say, if a company is not paying back its bonds, it's in serious trouble.
That's right.
Brilliant. Thank you so much, Ben, for explaining that to us.